viewers. Welcome to the newest episode of our podcast, The Slarsky Brief. In this series, we explore hot topics in litigation, litigation funding, and everything adjacent. Today's episode is litigation finance by the numbers. We have two guests today. We have Charles Agee of Westfleet Advisors and Daiwei Chin-Penman of Parabellum. I'm Evan Freed. I'm a partner at Slarsky LLC. I focus on a range of commercial litigation. Much of my practice involves disputes pertaining to litigation finance, investment frauds, fee disputes, and legal ethical matters. We have two great hosts here today, and I'll let each of them introduce themselves. Charles.
Yeah, Charles Agee, I'm the founder and CEO of Westfleet Advisors. Westfleet advises parties seeking funding. So we work on that side of litigation funding deals with a company or a law firm that wants to secure litigation funding. We are probably best known for running a competitive process for those types of clients, but we also do other ad hoc consulting projects, term sheet consults, that kind of thing. We don't do advisory work outside of the commercial litigation finance arena. Everything we do is in this space.
And Daiwei.
Hey guys, Daiwei Chin-Penman from Parabellum Capital. I run our commercial vertical here, which is everything non-patent. We're a commercial funder, and we like to work closely with fine lawyers like those at Slarsky.
Well, let's cut to the chase, gentlemen. The litigation finance market or the legal funding market, it's opaque. There's not a ton of data out there for a variety of reasons. In this episode, I wanted to have both you in because you each have a unique insight, and I want to talk about what the data really says or what it doesn't say concerning the world of legal funding. And through this, I want to talk also about what could be done moving forward to increase transparency, develop the numbers, and get some real clarity on what's really going on. Charles, anybody who knows the space knows that you guys for several years have been attempting to create transparency on the market and promulgate data concerning litigation finance. Walk us through what your group has been doing for the past couple of years to publish data on litigation finance.
Yeah, sure. It's funny you ask. Many people who don't know Westfleet well think of us mistakenly as a research firm because they've only heard the name through the Westfleet Insider, which is our annual report on the commercial litigation finance industry in the US. So we started doing the report, I think 2019 was the first year. So 5 or 6 years or so, we've published the data. In essence, and happy to drill down on this, Evan, if you'd like to, but in essence, our report is the only data-driven analysis of the commercial litigation finance industry. And the bedrock of the data set is data submitted to us, not actually to us. We hire an accounting firm that takes in the data that funders submit, anonymizes it, aggregates it, and then downloads it to us. And then we analyze the data and publish the report. The data set is all origination data. So number of new deals, types, portfolios versus single case. Was the funded party the plaintiff or the law firm? Pretty basic stuff. We always have to strike the balance between what we in the public would like to know versus what funders like Daiwei have the time or inclination to assemble for us once a year. I think we thread that needle pretty well. But at any rate, our data set includes the vast majority of the major participants in the industry. There are funders that don't submit data into our process. We have a methodology for extrapolating data that we have to account for those that don't participate directly. And there are also some publicly available data that we incorporate in the report too. A couple other highlights. The report does not include other parts of what we would still refer to as the litigation finance space. Like, for example, it excludes anything that's a consumer litigation finance transaction. It doesn't cover the area of law firm lending, largely mass tort, class action firms. It's just not directed at those funders. We try to limit the data set to just commercial litigation finance transactions with some nexus to the US. So we're also not measuring international funding activity.
So it's strictly single case financing, or I guess plaintiff portfolio financing, but not law firm financing, non-US or consumer.
But it would include law firm portfolio deals
right.
that are commercial litigation focused.
Okay, well, great. Daiwei, you guys haven't gone that far, but why don't you talk a little bit about the recent article by Parabellum or your colleague Will?
Yeah, my colleague Will Wiseman did a very illuminating article which goes into Charles's report and focuses on things other than what critics of litigation funding focus on. First of all, we're all grateful for the transparency that Charles brings. And I think a lot of the numbers in there, when viewed contextually, are actually very illuminating and helpful and tell the truth about a lot of things about our industry. And just so folks know, Charles and I have also been talking about other ways to potentially ask slightly different questions that would get us different data points, just so we can make sure that the numbers are not mischaracterized by the other side. And one of the things that's focused on a lot is this $16.1 billion number, which sounds large in isolation to any of us. And certainly folks on Capitol Hill have no clue what that means and don't know about it relatively compared to other industries, don't know the concept of AUM. So Will's article basically says a couple of things. First, don't look at AUM. It's a silly way to measure things. If you're going to measure it by that, here's some ludicrous results of that logic. What should you focus on instead? And this is the important point. So when we're talking about transparency, we're talking about Charles's numbers. What do we care about? What are we trying to see? I think that depends who you are. It's definitely in my interest for there to be more investor interest in the space because funders need to raise capital. It's not our own money. We're managing other people's money largely. So that's all well and good. And I want to show growth because it's an industry that's doing well and it's proving its concept. So that's one area. But I think there's ways to do that that are not misconstruing a number that to the folks that we're talking to would easily pick up on, the ludicrous nature of using that. So what do we care about? From a policy perspective, I think when the courts care about this, I think we're looking at what is this on a macro level and what does this show? And on a macro level, I think we know a couple of things. First, there's two predominant structures, portfolio and single case. Portfolio, if you consider that to be litigation funding, then you draw a very gray line with law firm lending, right? Because we all know in this call that you could have the same deal, it's recourse or it's non-recourse. The only difference is non-recourse costs 5% more, right? So you blur the line there, but from a big picture, do we even care about those deals if the things that, say, the judiciary cares about that have been brought to their attention are conflicts of interest, direct conflicts of interest financially, control of the plaintiff, and other things that arise by virtue of the privity of the funder with the plaintiff, which is not present in pure portfolio arrangements. So I think the single case number in Charles' report is very important looking at that. And then realizing, zooming out, that this is just a very rare phenomenon. Of course it is, because Evan, you're a practicing lawyer, you do very high stakes stuff, but I'm going to guess that if something comes in and it's a $5 to $10 million dispute, it's still very important for clients. They still pay your fees, but that doesn't cut it in our world. And what percentage of cases are big enough to even qualify for what we do? And then what percentage are good and run by people who are open to transactable terms, often with the guidance of someone like Charles AG or the General or the OG, as I've learned that some are calling him. But in any event, focusing on that single case numbers is very illuminating. And that's where I think we should go. And also focusing on other issues by using numbers without contextualizing them. For example, I can say this from experience, a large amount of investments that I'm in have another funder in them, one way or the other. We're co-funding it. They bought us out. We bought them out. There's some subordination. We're in with the client, they're in with the lawyers, or vice versa, or someone's in with the first party funding with the company, whatever it is. But if we're trying to figure out how many cases this thing actually touches, I think we have ways to do that. I want to keep this brief in line with the title of the show, but just one other thing that I'll share is one thing we've done recently at Parabellum and with the trade association ILFA is we've put together some more research. What we've done is we've begun a process of comprehensively going through public dockets to search for any case that touches litigation funding so we can see how much it's coming up in the courts. This is something the courts should know because it's one thing to read Westfleet's report, which talks about published decisions largely. It's another to look deeper because litigation funding comes up in all sorts of ways, including disclosure statements in the District of New Jersey, Judge Connolly's court, CD-Cal, ND-Cal, SD-Tex. It comes up there. It comes up on motions in limine, motions to compel, of course. So we now have those statistics coming together. And I think what we've seen, which is contrary to what the Lawyers for Civil Justice is trying to tell the advisory committee, is that this is It's a rare thing, but it's not in the shadows. It comes up. When it comes up, the courts deal with it. I have record of over 70 disclosure statements filed. In the dockets, there is proof reflected of 269 cases where there's litigation funding. 196 of those are federal, 73 are state. And about 50 of those are personal injury cases, which is its own line of case law. Largely follows commercial reasoning on relevance and work product, although that can erode because a lot of it's medical funding and you have collateral source considerations. Then in terms of disclosure orders, we have about 200 disclosure orders, decisions rendered by courts on discoverability of litigation funding, excluding injury, about 150. 62 of those are patent. About 140 of them are federal, and about 55 of them are state. So that's just some easy stuff that we're able to glean here, but that's also, I think, supports the narrative of Charles' numbers, the true narrative, which is how common this is, and that it does come up with regularity, and you have jurisdictions which are very high volume funded case jurisdictions where there is disclosure.
How much of the research that you guys are pulling comes from either bankruptcy or receivership dockets, where litigation finance is not only out there in the open, but also subject to court approval?
I'm just looking here. I've got 11 orders from the bankruptcy context, ranging from, I think we all know, fresh acquisitions at this point to, Lake Willens and Sanchez Energy on all these fun things, Legalist and Seven Stars on the Hudson, and our fame from Design Line Corp. So yeah, not that much. There's other instances though, where there's just approvals of financing facilities, litigation trusts, that sort of thing. But that doesn't always need to happen with court approval, fresh acquisitions notwithstanding.
Let's come back to the 16 billion number. For the viewers, could you guys just give some high level context as to where that number's coming from and why the folks in the litigation finance industry might say, well, off the bat, some pieces of that are inapplicable or potentially misleading. What portions of that 16 billion really shouldn't be there?
Yeah, I'll take a crack at that. And really just to pick up on something Daiwai said earlier, the opponents of the industry have really grabbed onto the AUM figure because it's the largest number. And maybe that sounds scary. And so that's why they only focus on that. We measure it, it's a relevant number in any asset class. How much capital in total as a snapshot is invested in that it's not irrelevant. But far and away, the more relevant number is what is annual deal volume. If you want to know what's going on in the mortgage origination market or auto loans or any other type of financing activity, you wouldn't ask, how much total capital is invested in all mortgages across the country that have a 30-year maturity, right? You would want to know how many new mortgages are written this year, what was the volume of deals this year or this month or this quarter. So that number is a fraction of the 16.1 billion. That number last year was around $2.3 billion.
Right.
And then Daiwai, you touched on this too. I mean, relative to the millions of cases that are filed every year in the US civil justice system, we're talking about probably a couple hundred, maybe 300 cases. This is like a rounding error on our civil justice system, right? So those facts don't sound good to the opponents of the industry. They want to focus on the largest, scariest figures, which actually even the 16.1 billion is quite small relative to other asset classes. A point that Will Weissman makes quite well in the article that we referenced.
Yeah, everyone should read Will's article in the National Law Review. I just want to point out a couple more things about AUM. So obviously it's silly to use that as a metric and it's distorted, but there's also nuances like, let's say Parabellum has 1.5 billion in AUM or something like that, right? Well, I can do, and I do a lot of investments in the US, but I can also do things in Europe and in Canada and the UK, and I do. And that I still have AUM that I could be using for the US, but I haven't deployed it here. I've deployed it over there. So that's the first thing. The second is, let me frame it as a tax issue, because we all lived through that recently. But if you frame it as a tax issue, let's pretend the TILIS tax were not retroactive, it only applied to deals going forward, okay? Which, you would hope that's the case if it ever gets passed, because retroactive was ridiculous. But let's say it's only prospective, fine, good. And you're taxing and let's say the industry is 16.1 billion AUM, and then let's say like the industry kind of stops doing new deals tomorrow, right? Like Champerty gets passed nationwide. We still have 16.1 billion AUM, but zero tax is being collected, right? The other thing that I think Will is going to focus on next in his next piece is two things. And one, Charles, the OG here, might be helping us track as well, is headcount. How many people work in this industry? If we're all pulling the strings on all these cases, I think we need a lot of people, and it's just an exceedingly small industry. And then how much money are funders actually making, right? There's this notion that funders
Mm-hmm.
get too much money from claimants, but how much are we actually pulling out of the civil justice system? We know how much we're putting in, how much are we pulling out? And that'd be very interesting. And there are some public figures you can get in to look at that, at least for, Burford and Omni and I guess LCM and Manolete.
Well, that's where I thought you were going with it, that, you create some assumption as to what that 16 billion, even if it were true, were to generate in profit or revenue, whatever the case may be. And does that move anybody's needle from a real tax perspective, or is there something else going on from a true deterrence perspective with respect to it? Let's change gears slightly. Have there been any attempts to measure industry growth or decline over the past several years? And what are some of the factors behind those trends?
Yeah, so our report actually does look at and compares the data year over year. And in the last 2 years, the size of the industry as we measure it, annual deal volume, has contracted. It's gone down, 12, 13% each year for the past 2 years. There's been some shakeout in the industry. It's been harder to raise capital. So the spigot is just not as fully on as it was 3, 4, 5 years ago. We also report on the number of active funders in the space, and there are always new entrants. There's some shakeouts. So that net number has stayed roughly the same, but that's not to suggest that it's static.
Yeah, for sure. I mean, look, we're a little bit of a fly on the wall at times, but we've observed the same thing that you have. Number one, new entrants from maybe 8 years ago deployed their money. They didn't raise a second or third fund, and they're kind of in harvest mode, or their portfolio is sitting a little bit static. And also, I think some lawyers have dabbled in litigation finance. They've taken out a line here or there for a case. And then the greatest competitor of litigation finance, the contingency fee, has in some ways prevailed, right? The firms who have an appetite to do something on risk, they weigh the costs or pitfalls of litigation finance against simply taking it on contingency, and they revert back to a model that's been used for a long time. Similar lens, what about attempts to quantify cases not funded? Have the acceptance rates gone up of cases that funders are evaluating and then funding, or are funders being seemingly selective with the cases that they're funding?
It's a great question. I'd love to hear Daiwai's views on this too, but we were actually just talking about this in the office this morning. What's the denominator for that? Is it every inquiry that, I mean, we get lots of crazy people that hit the website that we don't even call back. Does that count in the denominator? Is there some concept of a qualified lead and you measure from there? Is it, stuff you actually picked up and looked at and spent some time on, and how many of those? It's very hard to get to a denominator there that's meaningful.
Or what if I want to fund the case, but I can't because it's competitive or I can't get to terms or whatever else happens?
Sure.
I think AI is going to be a real problem for you, Charles, as I'm seeing, because a lot of the people who may not have the mental stability we're looking for in a counterparty, AI does have that stability, and the tomes they're writing us are much more structured lately.
I've noticed that too.
Yeah, you get these new applications that are structured like a lawyer's memo, but to chat GPT or whatever equivalent people are using, all of a couple seconds to spit out a memo that there's the next $1 billion case around the corner.
The
What about,
best we've come up with is to be very inclusive in the denominator, because it's really hard to slice and dice and just that is what it is. And you measure that year over year. And I think instead of how many of these deals did we fund, because to Daiwai's point, there are other factors that don't go to how selective you were. There's probably a better metric to look at how many of those deals did you put out a term sheet on. It's not perfect, but I think that's a very good proxy, especially if you're looking at this over a period of time, a good proxy for our funders getting more selective, less selective, But the reality is funders are extremely selective. I mean, I don't know what the percentage, the acceptance rate is, but it's less than 5% of deals that are coming in the door. It's probably way less than 5%.
It depends what you count. It depends on a lot of things, but it's also like you can manipulate those numbers. Like we used to spend money on our marketing, right? Google AdWords every day. A lot of funders do that. I think then they also bid on our name. Fine. The more money you spend, the more inbound you're going to have, right? But I think the focus needs to be on term sheets, like what's investment grade. There's gems, and then there's the big band of investment grade, meritorious, good, like risk reward, careful balance, capped upside, that sort of thing. There's stuff that's really good, then there's stuff that's really bad. So what are we counting? I think it's kind of a useless exercise. I don't know that we care if funders are getting more selective. I mean, we're also idiosyncratic. It depends what we've been through. A lot of it also depends on law firms, right? There might be a really good case, but I may know that lawyer is not trustworthy. Therefore, I might not do it, but someone else might, right? So there's all sorts of different variables. But I think we should be looking at just how many cases there are that get funded. I think it is important to measure commitments and deployments like Charles does. I think we need to see that it measures kind of industry health just to make sure that there are people out there still committing the dollars. Because if there aren't, and you see a decline there, it's going to be a lagging indicator where you'll see less funded cases later.
For sure. You guys are on the forefront of thinking about litigation finance on the numbers, trying to satisfy any concerns from the defense bar, from investors, from folks who think litigation finance might be too expensive or too cheap, whatever the case may be. What other analyses do you think would be interesting to continue to move in the right direction of increasing transparency and satisfying any concerns that might be out there?
I'll tell you something we're kicking around currently, and we may actually do this, is using a similar methodology that we've crafted for the origination data. Use a similar approach that ensures confidentiality and anonymity of all of the participants in the data collection effort. We may start doing that with some investment performance information, the goal being to create some kind of a benchmark that funders like Parabellum can tell their investors and know themselves, like, okay, we're underperforming, overperforming, outperforming relative to the average. There's nothing like that. There's nothing even close to that in existence. And the reason we would do it, I don't think there's a way for us to monetize that, but we would do it because I think that transparency would help attract capital to space.
I was actually trying to find one more number relevant to the last point, which is what percentage of investments that funders actually do come from existing relationships versus coming from cold?
Yeah.
Because that's also a big factor, right? It's in funders
sure.
generally to look at things seriously from trusted relationships who've had success in the past.
Yeah, look, it's a validation that particularly the big firms who are not hyper focused on contingency or risk-based work, if they're coming back to the well and satisfied with their experience in litigation finance, I think that's validating to the space. The thing I've observed and extremely helpful is, Charles, not dissimilar from you, the advisors in the space talking a little bit about risk pricing, right? Houlihan Lokey put out an article a year or two ago talking about how litigation can be priced from a public markets perspective. I know Burford has put out some literature on that as well, explaining to investors when we're marking investments on our books a particular way, this is why. And then, if you reverse engineer that, you can understand from either a law firm or a claimant perspective why litigation finance is priced the way it is, depending on the infancy of the case, the risk parameter, the type of litigation it is, and whatnot. And I've actually used some of that research in a case that we tried 2 years ago. And I found it to be extremely helpful because it used to be kind of pie in the sky stuff. And well, of course, litigation is risky, that type of thinking, but it's gotten far more granular and scientific as time has gone on.
Well, Charles has actually submitted an expert report about pricing of litigation in a federal case. So he is the OG, as they say, of that.
That's right.
That's right. Because there's also the issue of as we compete with contingency fees, right? Or as that's like the other model. Well, those contingency fee lawyers are saying, well, we put these costs out. Shouldn't there be some, return on that capital? It's considered a different way. It's complicated. You run into what's called the Agent Orange problem there sometimes. I think going back to transparency, there's two things. First, I think The other side, the critics, need to be reasonable, come to the table and make compromises with us like we've now done in multiple states, most notably with the US Chamber in Kansas. We have a disclosure regime right there that is balanced. ILFA, the industry trade body, negotiated that and supports it. And if that passes in other states, we'll have more at least state level data. On the federal level, we have the Advisory Rules Committee doing its study with the subcommittee chaired by Judge Proctor. We'll see where that comes out, but they may have recommendations on transparency, they may not. If you look at the 2023 report and recommendation by the Delaware judiciary, they don't recommend for more transparency, but they say if we're going to have rulemaking that increases transparency, we need proper guardrails against, protections against prejudice, essentially. So one way is legislation. We'll see what happens. Federally, there's a number of bills. Some of them are focused kind of on foreign funding, others not, some just MDL class. So legislation, maybe that's a way there's more transparency, especially with DNJ or Connolly-like disclosure regimes, which are bare bones and don't create any trouble, but kind of give people the comfort they need that there's no conflict of interest with the judge, that they know who's on the other side, et cetera. I will warn there are some pitfalls to disclosure that the critics need to consider. We're publicly funding a number of cases in the District of New Jersey, so it's all publicly disclosed. There are a number of defendants in that litigation who are now contacting us directly trying to settle and circumvent the lawyers and their own lawyers. So it's pretty interesting. The other thing I'll say is litigation funding, like I said before, it's happening all over the Western Hemisphere. It's very European centric because of its roots. There's a lot going on in the UK and Australia. Why is that important? Well, I think one of the things that's really important is that the class actions in those countries are not brought by lawyers on contingency, at least for antitrust, which is very capital intensive. They need funding. Funders fund class actions with court approval. We're doing it with court approval in a number of cases. The court gets comfortable that the terms are fair. It blesses it, makes sure there's the right provisions, determined to jurisdiction, whatever it is. In America, that's the gap. There's two ways our industry scales. Otherwise, it's going to stay kind of where it is because there's millions of cases filed every year. Maybe there will be aberrational years, but I think we kind of know how many good cases there are out there every year. And yeah, there's some flex in that, but I don't think that's going to change dramatically. So I think we're kind of be where we are unless we scale. There's two ways to scale. One is what some larger players, including Burford, have been doing. And this is scaling in terms of dollars, not necessarily cases. They do concentrate in a number of cases, but large corporate monetizations, you saw that with the dispute with Cisco, but the headline number is 140 million. That's a skewing distorted number, but that's one way you scale deployments in the field. The other is if you enter the class action world. So if we get to a place where funders are able to fund class actions in a way that's like other countries, that helps the market scale, but it also would be a lot more transparent because there would be judicial oversight of that. And I think, the class action bar is some people are curious about this, others want to preserve the status quo. But the bottom line is, if you think seriously as a plaintiff's lawyer about a big class action that's capital intensive, do you want to do it the current way with a portfolio, or do you want to do it with a funder all out in the open where you can win lead because you say, we have 10 million in committed costs on this from a funder. It's not subject to firm management committee. If any judge really digs in on these leadership beauty contests, you look a lot better with a funder than you don't. So anyways, I think there's a lot of potential there and that would increase transparency. So that's a project that some of us are working on as well.
Got it. So Daiwei, I think, took the next question from me, but Charles, maybe I'll hand it over to you. I mean, predictions for the market over the next few years, whether it be on data or otherwise, what do you see coming around the bend?
I mean, I would like to see an increased awareness or at least an increased level of education within the investor community of what this asset class really is. It's actually very different from any other asset classes that I know of. It has, some nuances that are, I think, not well understood. So maybe that's aspirational, but I'd like to see that. In terms of deal volume, I don't see any reason to think that it's going to move much. It hasn't changed much in the 6 years we've published the survey. It's stayed, pretty tight. Some years it's gone up a bit, some years it's gone down. So I would say the outlook in terms of deployment or new commitments is flat-ish. I mean, there has to be some growth just because there's like a legal inflation rate. So, flat would actually represent a decline in real terms. But I don't see any reason to think that the market is going to change significantly in the next couple of years.
Well, look, from my perspective, I would add that, you talked about awareness and education among investors. I think that the litigation bar, both plaintiff and defendants, have become more sophisticated. I think the plaintiff side is more aware of the options available, whether it be contingency, portfolio, insurance products, or conventional kind of 1.0 litigation finance. Defendants are making creative arguments, and they're also kind of pulling punches on things that they know won't be successful, disclosure motions and things like that. And I think as the jurisprudence develops in that area, you'll see the silly arguments given the back of the hand, and really only the best arguments or the ones that are truly novel being considered by the courts as all this stuff becomes kind of less taboo.
I think we're in like an inflection zone for the industry about, so like you say, counterparties have different options available to them. So do LPs, right? Or investors. So you can raise on the mystery of the history. We've got a number of players with track record, but not that many, right? And so we're at this point where if you're on your first fund, you're raising your second, no one's expecting to see track record yet. Your third, you should at least be showing, concept it's working and have some track record. Fourth, definitely. And I think you can see where different funders are in their funds. We're kind of getting to there. So it's LP interest. And do they want to come in as LPs? Do they want to invest in stock? Do they want to take direct positions? I think that's one thing. And then the second thing would just be kind of, will there be new entrants into this market? I think it's really hard.
Sure.
Maybe this MSO thing blows up, but that's private equity. That's not litigation finance, right? And so will there be new entrants? A lot of the entrants in the market, the money comes from a lot of common investors anyways, right? And these are all non-sovereign investors that we share. It's not, my ancestors in China my relatives pulling the strings. So will there be new entrants? Well, there are high barriers to entry because, Charles, as you know, these cases are only getting more expensive. Rates are going up despite Gen AI adoption, if that ever happens. But, rates are going up, it gets more expensive, especially as we switch more to portfolios. Well, if you're going to do a portfolio, you want there to be at least 3 cases. Each case with a real law firm, the big type of blue chip cases we're doing, you're going to put at least 5 million into those cases, often much more. So that's 15 million right there. You want to diversify your portfolio, you don't have too much concentration, so you need 10 of those deals. Well, then you need $150 million. Who can go raise $150 million? Even operators in the space who have done a fund or worked at a fund and raised their own, that number is not attainable very easily, at least with discretionary abilities over that capital. So thank you for indulging me, everybody.
No, for sure. I mean, look, it wasn't really data over the first 5-10 years of the existence of the market in the United States. It was war stories, right? It was anecdotes that were sticking out. Now with, folks like you guys been out there for over 10 years, you're seeing real data, presumably portfolios getting better over time or from fund to fund. And I imagine that data will creep into the public and create some of these standards that you guys have talked about. Well, with that, thank both you guys for joining. The three of us have known each other for a long time. We care a lot about these types of issues. I know the three of us care a lot about getting some of this data out there to cure any concerns that are out there. This conversation will continue to evolve. So to all the viewers out there, thank you guys for joining this Larski brief, and we will catch you guys next time. Thank you.
Thanks, Evan.